Have you ever wondered about the curious phenomenon of why a vast majority of investors, regardless of their experience, instinctively make decisions that end up being detrimental to their investments? It seems like a perplexing puzzle at first glance, doesn't it? This puzzling behavior, however, unravels itself when we start to look at it from the lens of human psychology. The psychological aspect here is neither trivial nor peripheral. In fact, it is our complex and multifaceted human psyche that plays a significant role in these missteps. It is the very fabric of who we are that comes into play, leading us to make decisions that are not always in our best interests. The often unrecognized interaction between psychology and investing is a facet that gets sidelined in the grand scheme of things. It's an area that absolutely warrants our attention and careful analysis. Diving deeper into this realm would not just be an intellectual exercise but also serve as a practical guide to better comprehend and manage our investments. The alluring world of investment isn't confined to the arithmetic of gains and losses, or the ebb and flow of market trends. Rather, it is predominantly about understanding the human mind, its subtleties, its shortcomings, and the biases that cloud our judgment. So, step into the captivating world of mind over money, conquering behavioral biases in investing. Here we are not just deciphering the mechanics of investing but also unraveling how our cognitive biases play a pivotal role in our financial decisions. This is much more than a deep dive into investment strategies. It's a voyage through the fascinating landscape of the psychology of investing, where we dissect complex psychological concepts, shine light on various behavioral biases that investors frequently succumb to, and most importantly, arm ourselves with the wisdom to beat these deep-seated biases. By acquiring this pivotal understanding, we can revolutionize the way we approach our investment decisions. In today's session, we will delve into the intriguing world of the psychology of investing and provide you with valuable insights to conquer our inherent biases. So, buckle up as we embark on this enlightening journey of mind over money, conquering behavioral biases in investing. One of the most common biases that influences our decisions, including our financial and investment choices, is known as confirmation bias. This bias, deeply ingrained into the human psyche, not only governs our behavior, but also strongly affects our investment strategy. It's an instinctual response where we tend to seek out information, data, or opinions that strengthen and reaffirm our existing beliefs, ideas, or preconceived notions about market trends and investment opportunities. For instance, an investor with a fondness for technology stocks might focus on positive news about tech companies and ignore potential red flags, thus reinforcing their existing preference. Similarly, if someone strongly believes that real estate is the best investment, they may dismiss or overlook information suggesting a potential property market downturn. Our own echo chambers, in the investing world, are often filled with articles, news feeds, and forums that support our investment thesis, wrapping ourselves in a comforting blanket of financial self-righteousness, while conveniently ignoring or outright dismissing any evidence that contradicts or challenges our investment bias. This process often happens automatically, led by our subconscious preference for familiarity and agreement in our investment decisions. It can shape every aspect of our investing journey, from our choice of financial news outlets to the way we interact on financial forums, even influencing our relationships with financial advisors. The danger of bias in investing lies in its ability to blind us to new opportunities and potential risks, to stunt our financial growth, and keep us stuck in our ways. It can fuel investment mistakes and losses, pushing away diverse investment strategies that could enrich our portfolio and broaden our financial horizons. To counter this bias in investing, it is essential to expose ourselves to a variety of financial perspectives. Dedicate time to research and understand contrary opinions, actively listening to and considering differing viewpoints, challenging our own assumptions, and stepping out of our comfort zones. This could involve diversifying portfolio holdings, seeking advice from a variety of sources, and regularly reviewing and challenging our investment thesis. To overcome confirmation bias, we must proactively seek out diverse perspectives and put our investment assumptions to the test. The herd mentality, a behavioral bias, has a significant impact on our investment decisions. It is a deep-seated psychological tendency that compels us to move in sync with the majority, often leading us into the turbulent waters of unwise investment choices. This propensity to mirror the collective actions is particularly pervasive in the complex world of investments where the future is shrouded in uncertainty. This instinct to blend in with the mass viewpoints and activities creates an illusory bubble of security, subtly nudging us towards abandoning our financial wisdom. In the face of a bullish market, the herd mentality can drive us to irrational exuberance, pushing us to invest in overheated stocks. In contrast, in a bearish market, it can induce unjustified pessimism, leading us to sell off beneficial assets. However, it's crucial to keep in mind that each investor's journey is distinct, molded by their financial objectives, risk appetite, and time horizons. The topography of this journey is individualistic, and hence the herd mentality is a flawed approach. The investment sphere is filled with a myriad of financial instruments, each laden with its specific risks and rewards. Therefore, overcoming herd mentality requires a diligent and meticulous analysis of these factors, cutting through the financial jargon and metrics, and evaluating the performance of the firm beyond just market sentiment. It's essential to develop a deep understanding of market dynamics, strategies that will help us resist the pull of the herd mentality. Investing is not about trailing trends or copying the crowd, but about making well-informed decisions based on our analysis. Understanding the risk-reward scenario and constructing a solid investment portfolio that dovetails with our financial goals is key. To conquer this bias, cultivate a habit of independent thinking, stay informed about market trends but avoid irrational exuberance or pessimism, seek professional advice if needed, learn from past investment mistakes, and importantly, have a disciplined and patient approach towards investing. Remember, following the herd might seem safe, but it's not always the path to financial success. Emotional biases undeniably play a critical role in investing, a phenomenon that all investors grapple with, irrespective of their level of experience. This is predominantly because investing isn't merely a financial endeavor, it also harbors personal sentiments. Investments often embody an individual's hopes, dreams, and aspirations. There exist several varieties of emotional biases in investing. A common one we all experience is the fear of missing out, often abbreviated as FOMO. This specific emotion is triggered when we observe others reaping profits from trendy investment assets. We may feel an overwhelming urge to join this profit-making trend, often disregarding the real intrinsic value or the long-term potential of these assets. On the other hand, we have loss aversion, a bias that makes investors hold on to losing stocks for longer, hoping they'll bounce back. This emotional bias can cause investors to miss out on opportunities to invest in more profitable ventures. Another prevalent bias is herding, where investors follow what others are doing rather than making independent decisions. This type of behavior can lead to financial bubbles and crashes when everyone decides to buy or sell at once. Overconfidence is another bias, where some investors may believe they're more capable of predicting market trends than they truly are. This can lead to risky investment decisions and potential financial losses. The fear of loss is another extreme emotional bias. This fear can be petrifying, often triggering panic selling during market downturns. It's all too easy to let fear supersede rational decision-making, leading us to prematurely dispose of our assets in a misguided attempt to cut losses. Overcoming these emotional biases requires the crafting of a robust investment strategy. This strategy ought to be rooted in meticulous research, thorough analysis, and an understanding of market trends. Diversification can also be an effective strategy to minimize risk. By spreading investments across a range of assets, we can buffer against potential losses, create a balanced portfolio. Impulse decision-making based on temporary emotions can lead to catastrophic financial outcomes. Therefore, it's essential to detach ourselves from short-lived feelings, approach investing with a clear mind, and adhere to our predefined strategy. We must continually remind ourselves of our long-term objectives, adhere to our investment plan, and avoid making impulsive decisions driven by short-term emotions. Investing, after all, is a marathon, not a sprint. By acknowledging our emotional biases and actively working to mitigate their influence, we can make more rational, profitable investment decisions. Recency bias, a concept deeply rooted in our cognitive functioning, is an intriguing psychological pattern that often leads us astray. This bias prompts us to attach disproportionate significance to recent events and observations, often at the expense of historical data and long-term trends. It's a form of cognitive distortion, a kind of mental illusion where we base our decisions on our most recent experiences and the information that is freshest in our minds. Essentially, it's like having a myopic vision, but instead of struggling with distant objects, we're failing to focus on the broader, more comprehensive view. Recency bias is, in essence, a tunnel vision that occludes our judgment, making us fixate on the immediate past and the present, thereby casting a shadow on our ability to draw inference from historical data. This kind of pattern recognition error can have detrimental consequences on our decision-making, causing us to overlook significant trends or patterns that have unfolded over a longer time frame. But fret not, for overcoming the recency bias is not an unreachable feat. It involves employing strategies that help widen our perspective and develop a more balanced view. One key step is to consciously take a step back and analyze long-term trends. This not only helps to put recent information into perspective, but also facilitates a comprehensive understanding of the situation at hand. Another method to tame this bias is to deliberately seek out and consider historical data. This can prevent the overshadowing of relevant past information by recent events. Not only that, but it also helps to understand that information, whether old or new, should be weighed based on its relevance and accuracy, rather than its recency. Finally, fostering awareness about the existence of such a bias within us is crucial. By recognizing that we're inherently predisposed to favor recent data, we can counteract this inclination and strive for more balanced decision-making. Recency bias is a formidable barrier to good judgment, but with self-awareness and strategic thinking, it's a barrier that we can surmount. In conclusion, understanding and conquering our behavioral biases is not just significant, but indispensable for successful investing. These biases, which often stem from our subconscious and emotional reactions, can cloud judgment and lead to less than optimal investment decisions. To truly achieve victory in investment, it's crucial to question your assumptions. Do not get swept up in the tide of popular sentiment, as following the crowd can often lead to detrimental decisions. Reining in your emotions is another crucial step in overcoming these biases. Investment decisions driven by fear or greed rarely pan out in the long term. Also, do not underestimate the importance of examining historical data. Past trends and patterns can provide valuable insights for future decisions and help to avoid repeating mistakes. These tactics, when combined, enable rational, thought-out investment decisions. Conquering our behavioral biases can significantly boost the performance of your portfolio, leading to greater wealth accumulation. The importance of this cannot be overstated, as it directly impacts your financial stability and future. Thank you for watching this video. If you found it helpful, please subscribe to our channel for more valuable insights on investing and personal finance. Your journey to successful investing begins here, and we are here to guide you every step